This article is about how India is making FDI to the other countries. That is outward FDI or outward foreign direct investment. We have taken this article from two different sources. The first one is Business Standard and the second one is The Wire. Both these, one is the digital format, the other one is the newspaper. Both these articles have provided us the information on what is the outward FDI. Outward FDI basically means Indians making foreign direct investment to other countries, maybe in the neighborhood, right? So in this case, that suppose there is an Indian company and this Indian company has invested in Singapore company and the Singapore company is in Singapore. Like Indians are starting selling two-wheelers in Africa. Indians are selling four-wheelers in American markets. For that they require FDI. So when Indians make FDI in other parts of the world, it is known as outward FDI, FDI going from India to other countries. Now let's understand. Now the article says that FDI has increased to 5 billion in the month of June. So the 5 billion has been sent from India to the other countries. Now is this a good sign? Well, technically it is a good sign. It shows that India is expanding, India is becoming global. But is this a tweak? Is this a channel of creating or diverting the black money from India to the other parts of the world? Okay, we'll look that throughout this article. Let's understand that how this article has been shaped. Now, the trend says that India, the outward foreign direct investment in India increased to 5.03 billion in the month of June. So that's the total amount that we have sent from India to outside, which is more than, right, 2.9 billion, which was there in the last year. So it is almost close to double from what we had last year. So outward FDI is improving year on year. We are sending more money outside India. But please understand one thing, guys. Outside FDI does not mean that this money is lost. This money has gone somewhere else. Now it will come back again in terms of profits, in terms of dividends, in terms of interest. It will come back to India only extra. So if 5 billion is going, let's say 6 billion will come back to India. Now the types, basically the components. So outbound FDI comprises of three big segments. The largest one is the guarantee, where one company gives a guarantee to the other about the payments. Then the second one is equity capital, when one company purchases the shares of the foreign company in foreign, and the loan given by one company to the other or individuals to the others, right? So these are the three components. We'll take them deeper into the next slide. The highest outflow was in the IT sector. So Indians are making more and more investment in terms of information technology, software as a service, SAS, SaaS, right? IT enabled services, ITES. So let's say Tata Consultancy Services is now opening a new office in Africa. So they are opening a new IT office over there. So we are making a foreign direct investment over there. So highest outflow was seen in the IT sector and followed by consumer goods and power sector. So these are the top three ones. The highest money which is going from India to other country goes to Singapore, which is close to 22%. 20 to 22%, and it's the highest. Singapore is a country where Indians are forming their own companies. Yes, you may go and read the case of Flipkart. So Indians are forming companies in Singapore, because creating a company in Singapore is far easier than creating a company in India. So the money is going from India to those companies which are owned by India, created in Singapore. So those companies, they have headquarters in Singapore. So the money from India going to those companies, by the way, they are owned by Indians only. So this is like a money going from India to the Indians living outside India and coming back to India, right? So this is a kind of a circle that they have created through this outward FDI. Now, before moving towards the outward FDI, we should understand what is FDI. Foreign direct investment is the total amount of money that has been invested in long-term assets. and the total ownership under FDI is more than 10%. That's the point. Let me give you a highlight for that. Let's say there is company A and there is company B. This company is in India and this company is in US. Oh, pardon me. Now this company A, now I'm talking about outward FDI. Now this company A is going to invest in company B. So this company A has provided loans to company B in US. Now as this money goes, there are two conditions. Number one, this money was invested for long term. So it is not going to be like invested today and withdrawn tomorrow. So it is going to be long term. The second important reason is that this money which they have invested is going to be invested for more than 10%. So this loan that they have given to that company should be more than 10%. If it is less than 10%, it is foreign portfolio investment, FPI. So to be FDI, these are the two conditions. So 10% plus stake and long term. These are the two conditions for which money has been made to the company B, right? Now let's understand more dimensions of FDI. Investment of 10% or more in listed companies. It can be in the unlisted company also, right? So if a foreign company is making investment in India, this is inward FDI. So investment of 10% or more in listed companies in India, right? Less than 10% is considered to be foreign portfolio investment, as I told you. Who can receive? Company can receive, partnership firms can receive, venture capital fund can receive, limited liability partnership can receive, even the startups can receive. An individual is not considered to be a company, right? So individuals, if they receive any money, it is not considered as a foreign direct investment. Routes. There are two routes. Number one is government route and second one is automatic route. Government route is also the approval route. You require government approval. Now government has a specific department for that. So we have foreign investment facilitation portal. It's a website. So anyone who is looking for an investment from government approval, they have to go to this website and concerned administrative ministry or the department will be given. Let's say the investment is going for the IT. So the respective ministry of IT will be receiving that application. If the investment is coming, let's say in defense, so it will go to the Ministry of Defense. So it will be distributed respectively. After that, if the investment is over 5,000 crores, if the investment is over 5,000 crore, it will go and it will be approved by Cabinet Committee on Economic Affairs. Then, so this is the approval route. The second way is automatic route. No prior approval is required from the government. That's it. No prior approval is required. One-to-one interaction is important, right? So two companies, one is making the investment in the second one, they will have their own duty. Paperwork will be done so that government will be informed. Government and RBI will be informed, but approval is not required. So this is automatic approval. FDI from the country with which India shares its border is allowed only under approval route. That is the first route, because of money laundering and many other things. Like, so money coming from, let's say, Nepal, or money going to Nepal, or money coming from, let's say, Bangladesh going to Bangladesh, government approval is required. Eligible instrument. How can we make money? How FDI is being made? Through shares and equities, warrants, fully compulsory and mandatory convertible debentures. So they can purchase debentures as well. Foreign currency convertible bonds, foreign currency exchangeable bonds, depository receipts and others. What are these? There is a separate video for that on this channel. You can go and you can watch that video on all these things which have been mentioned over here. These different types of bonds and other things, they have been discussed. So these are the instruments through which it can be used. Who cannot receive foreign direct investment? These sectors. lottery, gambling, betting, chit funds, nidhi company. These are the first. These are the fives which cannot receive FDI. So this the betting apps that you see these days, Rummy Circle, My Circle, all those kind of, right, Dream 11, they are providing betting. They do not have FDI approval. Trading or trade in transferable development rights, TDRs, not allowed. Real estate business, not allowed. Construction of farmhouse, not allowed. Cigar manufacturing, not allowed. Activities not open to the private sector, which includes railway operation in atomic energy and atomic minerals also. Atomic mineral. All the discussions that I'm conducting right now, these notes are given in the description box. So if you want to download, you can download. The link is mentioned. You can have all these notes in the PDF format. Now, sectoral cap, composition cap of all foreign sectors or foreign investment are being given. In some sectors, it is 26%. In some sectors, it is 49%. In some sectors, it is 74%. So in some sectors, it is 100%. So 100% FDI is also allowed in multiple sectors. So foreign company can come, can acquire 100% of the domestic company, or can make 100% investment in a particular sector. Note, once FPI turns FDI, that is more than 10%. Let's say there is company A which is investing in company B. How much investment they have done? They have done a small investment of 5%, not 10% or more, only 5%. It is FPI. If it goes beyond 10%, let's say they have invested 15% to an Indian company, then it will be considered as FDI. In the next year, they may reduce it to 5%, but it will remain as an FDI. So once FDI will always remain FDI. Now, this is the basic difference between FDI and FPI. So it is long term, short term. Long term presence in the foreign country can come, can go anytime. So that's why it is known as hot money. They can come today and by the evening they can leave. They will buy certain securities or assets or shares. In the evening, they will just sell all of them. It's so quick. Control, very significant control over the particular entity. So if company A has purchased company B's shares, so company A will have a substantial control on company B. Even the management practices, work culture can be influenced. Nothing over there. Investment in tangible assets, buying of the building, material, salaries of the employees, management, human resources, everything is under control. Only the financial assets. Returns, profit, dividend, capital appreciation, dividend, interest, capital appreciation, not profit. Here we are making profit. Over there we are not making profit. Why? Substantial difference in the assets. So here we have tangible assets. Over there we don't have that. Because here they are running a business. Over there they are just the investors. Running a business generates profit. As an investor, it does not. Profit regulation. Government policies regulate more or less flexible under SEBI. Impact on economy, creates job, bring technology, economic growth. Over here, liquidity shocks. As I told you, they invest quickly, they withdraw quickly. That's why. So it is hot money. FPI is very, very, you can say, unexpected, more or less. FDI on the other hand is very, very trustworthy in terms when you compare the both. In the recent years, we have seen the FDI has been reducing. In the previous video also, in one of the current affair class, I have discussed that thoroughly. FDI outflow components. Now these are the three types how FDI goes out of country, that is outward FDI. The first is equity capital, buying or disposing the shares of other companies in the foreign area. Simple. So Indians buying or selling shares of a foreign company in foreign area. Reinvested earnings. Let's say I have invested in XYZ company in America and I have earned a profit out of it. I have earned a lot of profit in the last 5 years. I don't want to bring that profit back to India. I will reinvest that profit in the same company or maybe in any other sector. That is reinvested earnings. Intra-company loans, one company giving loans to the other company, as simple as that. So guys, these are the three types of outward FDI that has been there in practice actually. Outward direct investment from India, as you can see, these are the trends. UPSC can put a question on that. Singapore is the highest shareholders. So the highest money going from India to Singapore, right, is there. 2,03,233 crore. That's a huge number, guys. That's literally a very huge number. Where this money is going? In Singapore, or the companies by Indians in Singapore? So because that company was formulated, registered in Singapore, it is considered as a foreign entity. It is not an Indian entity, despite the owner can be Indian. Then UK, US, UK, Netherlands, UAE, Mauritius, Switzerland. Now Mauritius, Switzerland, Bermuda, Cyprus, Jersey, right? These are the countries which are known for round tripping. They are known for black marketing. They are known for tax evading, tax havens. So maybe this money which is going out of India is maybe a black money, which has been converted into white and then round trip, and they have been going to the other countries and revolving around. Now with this discussion in place, I am giving you this two questions to practice. You can pause the video and you can go through this first question, and then you can also go through this specific question. I would love to see your answers in the chat box.